morning, everyone. Good morning. Welcome to our year-end tax and estate planning seminar. I'm Monica Young. I'm the broker of Just Global Inc. and the host of Global Real Estate Investor Club. This morning, we are very honored to invite Mr. Michael Lee to be the speaker. And Mr. Michael Lee is the managing partner of Rue Attorneys. And he is also the board member of California State Bar Legal League Specialization Board. And Michael has extensive experience in international estate planning and business succession. With a bilingual and bicultural background, Michael recognizes difference in cultural values as well as expectations of estate planning. His current practice focuses on family wealth preservation and asset protection. So today, he's going to share with you his latest observation. Would you all please welcome Mr. Michael Lee? Hey, Michael, you have the floor. Welcome.
Oh, thank you. Thank you, Monica, for the kind introduction. I really appreciate it. I'm really excited to be here this morning in this October, somewhat getting chilly morning. And very happy to see the seasons changing, and also very happy that I can actually bring some news with some actual focus and some meat on the bone to tell you what's happening. As I have been, a practitioner in the area of taxation, and of course, I'm also a professor at Santa Clara University School of Law for taxation and also bankruptcy, which is my favorite class to teach. A lot of fun. Watching this as an observer and as an academic observer, it's very interesting to see what Congress is doing, but it's been very frustrating as a practitioner, as an actual practicing lawyer, because it has been very unclear what Congress is trying to do and what changes we are going to see at the end of the year. So just as Monica introduced me, I'm Mike Lee. The managing and founding partner of RUI Attorneys. So we are a Silicon Valley based law firm practicing generally in estate planning, taxation, and estate administration, though we also do some business counseling and other things like that. So background, I've worked a good number of places, worked for the Internal Revenue Service, great job. There. So I hope you could hear me. It popped up muted, but I think we're all good. So
yes, now we can hear you.
Oh, great. So worked for the Internal Revenue Service, worked for the U.S. Attorney's Office as a tax prosecutor, and also worked for the district court. And as I mentioned, practitioner now, and then also professor at law over at Santa Clara. My partner, Xiaowei Li, she's another attorney in the office. The reason I'd like to introduce her is we also have full Chinese language services for anyone who would like or need that service. And we do a lot of planning and work for international persons. We are oddly familiar with things that are somewhat unusual for planners, like the US-Australia tax treaty, the US-Canadian tax treaty, all of those things. We deal with that quite a bit. So let's get into what's going on. What are we going to be talking about here? So we are talking about this. What we're talking about and what I wanted to share with everybody is, if you've been following the news, you've probably been struggling to try to figure out what is actually happening in Congress, and most importantly, what does this mean to me? What's going to happen with this, and where are things going to go? And I'll give you, it is pretty complicated what's going on out there. And right now, let's give you a little bit of kind of the gestalt on this, the kind of overall 1,000-foot view of what's happening. Previously, under the prior administration, the Trump administration, taxation rates, enforcement, general regulations in the tax law were fairly loose and fairly light in terms of heavy rate application and heavy enforcement. So during the Trump administration, we generally had, I wouldn't say we had the lowest rates. They weren't like, the Bush administration rates, which were quite low, but we had relatively low rates. We also had a very, very high estate tax exemption, which we'll talk about that in a moment. And actually, if well, I'll pivot there in a moment when we go over to the specific taxes. But for both of those things, we had generally an easy go of it during the Trump administration. Even before that, in the Obama administration, it was really not so tough, actually, especially, thinking two different tax systems, income tax and estate tax. Estate taxing under the Obama system was actually improved quite a bit. There were actually a number of situations that got improved, like the deceased spouse unified exemption. There were a lot of improvements. So we've basically had two administrations go by, one a two-termer and then one a single-termer. So let's say, all of those years, 12 years there, a pretty, not so, heavy enforcement, well, not so heavy revenue collection by the government. Obviously, we've just gone through a global pandemic, massive, massive government spending. The government they're coming up a little short on their bills. They always have. We have a massive deficit. So that has continued, and there is now some impetus to tighten up and to begin increasing taxes. In addition to this, as we'll see, this budget reconciliation bill, in addition to the increase in taxes, the budget reconciliation bill, the Biden's Build Back Better Act, is a massive, massive $3.5 trillion as proposed, basically to convert the entire US economic system into something that looks much more like France or Germany, in a sort of birth to death, total, so they call that sort of a welfare nanny state, total government care, the whole go. Massive spending package. Needless to say, that has to get paid for somehow. And they are proposing very, very substantial tax increases. So let's get into what are we following. And the reason why I'm going into this background, like a lot of people say, why are you going into all of this background? Can't you just tell me what the law is and what I'm supposed to do? I'd say, I'd love to do that. I've made my entire career knowing what the law is and then telling you what to do. That's exactly what I'd like to do. The problem is we are not 100% sure what the law is going to be. We are much closer than what we knew in the spring and the summer, but we are not sure because at present, there are two major things going on in Congress. There are two bills floating around, and one is the infrastructure bill. So there's the infrastructure bill, and that's the much smaller one. And the infrastructure bill is smaller. The infrastructure bill has fairly minor tax changes. The infrastructure bill, if that passes, if that works out, you're really not going to notice very much unless you are a securities broker. If you're a securities broker, you probably know what to do about that, or you do a lot in the cryptocurrency, Bitcoin, Ethereum, all of the Coinbase, all of those things, or if you're over in that space. If you're in that space, you're going to see a lot of reporting regulations and all of these things. And then the last one is if you're a very large employer, there's going to be a change in this employee retention credit. So the infrastructure bill is not really heavy on tax changes. The infrastructure bill is not so heavy on spending, though there's a lot of spending. Infrastructure, what's this for? Building roads, building airports, building bridges, fixing dams, fixing the power grid, all of these things. And that's one bill, that's one thing. The second thing on the other side, the flip side of this, is the budget reconciliation bill. The budget reconciliation bill is the $3.5 trillion massive, huge conversion of the US economy into a European style sort of cradle to grave welfare state. That's the reconciliation bill. Needless to say, the infrastructure bill is likely relatively easy to pass. The infrastructure bill doesn't propose to do too much. It doesn't propose to do very much in the taxing space. It's a spending bill and is targeted on infrastructure, which is generally broadly popular. People want roads to be fixed, and we don't want dams to fall apart, and we want the power to work. Pretty popular. The budget reconciliation bill is massive, and it is massive, massive spending. It is the largest spending that we've ever seen in the United States, including the New Deal. So the New Deal under Franklin Delano Roosevelt, it's larger than that. It's pretty significant. Obviously, the budget reconciliation bill is much more controversial. And because it's much more controversial, it's much more fluid as to whether or not it's going to pass and what's going to actually be in there. So this was all floating around middle of September. And the thought was that, well, the infrastructure bill would pass first, and then the budget reconciliation bill would be basically, Congress, as there's an old joke that many of you may have heard, is law, like sausage, is best when you don't know how it's made. And, when you start talking about the budget reconciliation bill, it gets messy, and people horse trade, and things get taken out, and things get put in, and pork gets put in, and pork gets taken out, and that's in fact the exact word, pork barrel politics. That's what it's about. Well, something interesting happened in that the party in power of Congress, the Democrats, have some party split about how this should operate procedurally. The infrastructure bill is held up. They want both of the bills to be passed together. There's all kinds of sort of up in the air situation about these two bills. So the thing to just remember about this, and before we move into the next slides that I have for you and the following information, is what we'll be mainly talking about is the budget reconciliation bill, the one at the bottom, the major tax change bill. Everything in there is proposed, and we're really going to have to just keep watching the news, watching the Capitol reports, watching the information coming out of Washington as to where that bill is going and what we think is going to happen there, because there are a number of things that are put in the bill. Many of them are pretty heavy reaches of things that I thought, wow, that's a pretty extreme change. It may get cut out. It may not pass at all. It's unclear. It's a little bit unusual considering that the Democratic Party has both the House and the Senate with the vice president voting, should be able to pass this, but seems like it's a heavy lift, partly because the bill is so big. So what I would recommend is, again, understanding infrastructure bill, that's one thing, not a lot of tax changes in there. If you hear that passes, probably not very much is going on in there for taxing life. Budget reconciliation, we do have to follow that. I have to follow that one into more granular detail, because the bill that actually gets passed may not be, and in fact, it's probably highly likely not going to be the bill exactly as written. So let's see what's actually going on in there. So the Build Back Better bill has many, many things in there. I'm just going to talk about the major tax issues that affect most people. There's a lot of granular detail, again, of all kinds of changes for all kinds of other transactions, S corporation conversions, the global intangible asset changes, all kinds of unusual things there, carried interest deduction stuff. We're not going to talk about any of that. We're just going to talk about the core stuff that's coming forward. So what is the core stuff that is proposed in the Build Back Better Act? Well, the first thing is this: change in long-term capital gains rates. What are we going to hear a lot? The news that I'm going to bring you, unfortunately, the news is in, but the news is bad for many things. So in terms of rates, so long-term capital gains tax rates, generally, the plan is to go up. Generally, the thought is there will be the 25% rate, plus there will be the 3.8% additional rate. So you have 25. So going from where we are 20, going to have the base, the upper rate be 25. So 5% points up. Plus, there's going to be the 3.8% Affordable Care Act. That's the Obamacare tax. Plus, there's going to be a 3% surtax. So the highest capital gains rate in the bracket may be up to 31.8%. 31.8%. That's high. It's not the highest it's ever been. It has been higher, but that is a relatively high tax. What does this mean? Well, I think most people on today are Californians, right? I think many of us are Californians. What this means is actually for us, it's actually probably even higher. No, probably it is, because we are going to also have to pay the California taxes. And California, as we all know, does not draw a distinction between capital gains and ordinary income. There's just the California rate. So the California rate, if you're in the 31.8% bracket federally for California, you're probably in the 9 to 10% bracket. You're looking at a 41, maybe 42% tax rate. 42% tax on capital gains. That's pretty significant. What's the proposal? So as we get nervous for this, asterisk. Start thinking about things like charitable remainder trusts, providing they're still available, as we'll see in a moment. But charitable remainder trusts, there are techniques to sell properties using charitable remainder trusts. You can also use this for stock. It works for stock too. So basically, if you have transactions that have very low basis, very high gains, before you sell, get your team, lawyer, accountant, real estate broker, or your financial advisor, get your team together. Don't sell until you've talked to everybody. I get this. Unfortunately, I'm getting into the time of year around October. I have people call up and say, Mike, I sold all my startup stock. I talked to the accountant. The accountant says I owe millions in taxes. What should I do? We're a little too late. You said you sold it. I had somebody sold it, bought a house, and then said, oh, I'm going to have a problem. I think I have to borrow against my free and clear house because the accountant says I have so many taxes, so much taxes owed. What do I do? I said, you sold the stock and then got the money and then spent the money. You have to pay the tax. So the bottom line on this is before you do capital gains generating transactions, talk to your team, accountant, lawyer, usually, lawyer, first on a lot of these things, get them involved because especially starting next year, we may have higher rates. So it's always easier to tax plan the transaction before the transaction happens. It's very hard after the transaction happens. It's very easy to prepare, one's parachute and where one's going to land before jumping out of the plane. If you jump out of the plane and then say, oh, I wonder if my parachute works, and I wonder if I'm landing in the right place, you probably should have guessed that before you jumped out of the plane. Once you jump out, you sort of land where you land. And that's the same thing with transactions. If you complete the transaction, if you didn't plan it, it's going to land where it's going to land. Very hard to control once you've already jumped out. So capital gains, the general thought is if this passes and this is included, and there's a pretty high likelihood that the capital gains part is going to stay. It's very, very popular. It's a big revenue raiser. Very likely that we'll be looking at in 2022 or maybe thereafter. 2021, likely nothing's going to happen. None of this is really proposed as retroactive to 2021. Likely we're looking at 2022 and looking forward. So capital gains tax, keep an eye on that. Next thing, moving right along, also looks like the individual ordinary rates will also go up. This for married couples earning over $450,000, the rate could go up to 46.4%. 46.4%. Again, Californians, we throw on, let's say, the top California rate's 13%, but very few people end up in that high rate. But if you're in the upper tens, that could be 56%. So, think about that. So, 12 months out of the year, 6 months, you're working for the government. That's, a very, very high rate. Again, it's for high net worth individuals. Again, it is also graduated. So my analogy is not 100% accurate because again, it's a progressive rate structure. So the lower brackets are paid, or the lower amounts are paid at the lower brackets, but we're starting to get into very, very high bracketing here. What should people start thinking about? People should begin to start thinking about things like charitable deductions, charitable lead trusts, donor advised funds, things like that. If you're in the upper brackets, sometimes family foundations, you need to start generating deductions. Two other things to be concerned about and why I put these things together: long-term capital gains and ordinary rates, and thinking of the local California. Remember, for California, we pay, of course, very, very high taxes. Remember way back in the Trump administration, that one of the few tax increases that they put through, the SALT cap. What's the SALT cap? S-A-L-T, SALT cap. State and local tax deduction cap. For many of you who remember, we used to be able to take a deduction for the amount of California state taxes that we would pay, our income tax and our property tax. So when we paid fairly hefty amounts to our state and local, gosh help you if you're in San Francisco and you also pay a city income tax, you pay the city tax, the city property tax, the state property, the state income tax, you're paying three of these things. You used to be able to take a deduction for all of those and reduce your federal taxes. The SALT cap during the Trump administration capped it at $10,000. $10,000 is the deduction. So again, many people, if you have $1 million house, you pay about $10,000 in local property tax. That's used up the deduction. Everything else you pay California income tax, not deductible. There has been some talk about repealing the SALT cap, but it is highly controversial recently. So that is potentially not likely to happen. So the thing to think about with both of those things are the issues of not only are the rates going up, but you also have to think of the rates going up in addition to the California component, and that California is not deductible. Techniques like we said, charitable remainder trust, techniques like we mentioned before, the charitable techniques such as charitable lead trust, donor advised funds, those are techniques. The other thing that I have seen some clients consider, particularly because of this work from home, work at one's convenience, people relocating to low tax states. Just want to mention that because there's a really, really interesting case about that. And I really like this case. This is a person who relocated to Nevada. And I just want to mention it is because I'm hearing this sort of relocate, I'm going to relocate to Nevada. I'm going to relocate to these different places. It can work. One can eliminate, if one moves across the border to Nevada, and you're on the Nevada side of, Tahoe, you're over in Las Vegas. Yes, you can eliminate the California state tax if you are a full resident of Nevada and you cut your California ties. There's a great case on this. Basically, it was a startup founder. The person was going to sell the company. They were going to reap very, very substantial income, and the person claimed he and his family moved over to the Nevada side, and he got a Nevada driver's license and bought a house over there, and all of this stuff, and they closed the transaction of him being in Nevada, and he sold the company and didn't pay the California tax. California Franchise Tax Board, of course, mind exploded and said they didn't pay the California tax, but they were really California. So it was a California company. They had done all the building of the company in California. We want the tax. So what did the smart auditors of the California Franchise Tax Board do? They asked for his wife's credit card statements. And it's becoming lovingly called the Starbucks case because the auditors basically just went through with a red pen and they just circled the Starbucks orders of coffee. And they circled all of the orders and they said, actually, far more than 50%, in fact, it was something like 75, 80% of the Starbucks orders were down in Newport Beach, California. And they said, looking at this, where you live is probably near your Starbucks. And where you drink coffee every day is probably where you are. And if 75% of the time you're in Newport Beach, you're ours, and we get to tax you. You didn't move to Nevada. You should have had 75% of your Starbucks orders in Summerlin or in Las Vegas or in Pahrump or Searchlight, but you were drinking your coffee in California. And if you're drinking it in California, we're going to tax you. And so it's kind of a fun, it's an interesting case of that you really have to be a bona fide resident to do that. We advise clients on how to do it, but you really have to have a total lifestyle change. And it's, appropriate for some people who really want to do it, not so appropriate for others. So those are about the rates. Important to think about how they're going up. Some of the more esoteric things, the next two are a little bit more esoteric, but do come up and are somewhat critical for Valley persons, is the qualified small business deduction, the QSBS deduction, that there may be a change here for QSBS. The QSBS is a great thing for founders who are founders of C corporations. If you have a small business, you qualify for the qualified small business, and then you eventually sell the business. You, under the law currently, and unless it gets changed, you could get 100% deduction of up to $10 million of the sale of the stock. So if I took my, business, I grew it. My business was worth about $9 million and I sold it for $9 million. If I was a qualified small business and I held the stock for 5 years, I'd pay zero capital gains taxes. I would get the $9 million and then not work anymore is probably what I'd try to do. That may get changed. It may get changed to a 50% deduction, and then the balance is at a different rate, not the 25% rate. It'd be at a 28% rate. The only thing to think about this is if you are a small business owner, and it can be any business. So like a lot of times people think, oh, I'm not a tech business, I'm a print shop. I had a very successful case. There was a qualified small business case. The guy that was rented fences. He rented chain link fences to construction sites. That was his business. Really good business. Sold the business to another construction company. QSBS paid zero capital gains taxes. And then, promptly stopped doing the construction business, and couldn't have happened to a nicer guy. Worked really hard to build a very difficult business that required heavy physical labor, but it worked out. The thing to just think about is if you are a small business, start thinking about this and making sure you're qualified for this if you're that kind of business. The reason is because the distinction between C Corp and S Corp, everybody really likes S Corp. It's passed through taxation. The income taxes are lower. But it depends on what your exit strategy is. Sometimes if your exit strategy, like for a law firm, an accounting firm, S Corp may make sense, and because the idea is that you're not going to really be able to sell this later. Other businesses, if it functions as a contained business and you say, I'm going to sell this, maybe you have to balance. So that's with the QSBS. The other thing though, which is a great segue, corporate rates. If you are a C Corp or operate C Corps, looks like this proposal would be moving to graduated rates and graduated rates up to 26.5%. Generally, if you're under 400,000 in income, it's 18%, but most C Corps earn more than that. You're probably going to be in a higher percentage. So what is the meaning of this? The use of the C Corp is, if this passes, may be less attractive than it used to be. It used to be, because the C Corp was taxed at 20% or sometimes less, depending on the situation, you could use it as a little wealth repository floater out there, and you'd set it up and it would earn income and it would pay taxes and it would just hold it. You used to be able to do that. If it is a 26.5% rate, that may dissuade us from doing that. So corporate rates may be going up. That's what it looks like there. The next thing is the area where I really sort of live, and is the place where we spend a lot of time, is the estate and gift tax exemption. So the estate and gift tax exemption is already subject to be reduced. And I think we've talked about this a good number of times. The estate tax exemption was adjusted up in the 2017 Tax Cuts and Jobs Act. It went from the base of 5 million to a base of 10 million. And then it was effectively, because of the adjustment for inflation, 11 million. It's about 11,626,000 this year. 11,626,000, very, very high estate and gift tax exemption. And it's per person. So husband and wife are effectively north of 22. They're probably around $23 million. So the estate gift tax exemption, very, very high. That is very good. It makes estate planning very, very easy to plan. The estate tax generally not such a problem, unless someone is relatively wealthy under these numbers. It is already set under the law as it is today. And this is not the Build Back Better Act. This is the Tax Cuts and Jobs Act, the 2017 Act, already set to go back to the 5 million, to sunset. We call it sunsetting in the taxing world. It was already set to sunset December 31st, 2025. So planners and people in this area, we generally thought, well, if it's going to sunset in 2025, we got time. We got time. We don't have to worry, so much, about anything, happening so urgently. We can go at a relatively reasonable pace about these things, because again, it's not going to drop off until 2025. Well, this year and a little bit last year, we've had some good scares, and the Build Back Better Act should give you a good scare. The Build Back Better Act says we should reduce it to the 5 million, which is effectively 6 million, but we should reduce it, January 1st, 2022. Next year, in a few months, it should drop down then. Good thing is they did not say that it will be retroactive to 2021. So what this means is, if you are a higher net worth individual, if you are a high worth individual, if you are a larger estate, and in Silicon Valley, this can be very, very easy to become one of these persons, because the estate tax captures all of your assets. There's a funny Simpsons, if you watch the cartoon The Simpsons, and it was about a horror movie, and it ate everything, and they had various characters saying, oh, did it eat this, did it eat that? They said it ate everything. The estate tax is that. It taxed everything. Did it tax my house? It taxed the house. Did it include and tax my 401k? It included the 401k, but not my life insurance death benefit. It taxed the life insurance death benefit. It includes everything. So like a lot of people calculate it incorrectly. They say, well, I don't include the death benefit because death benefit is outside my, it goes directly to the beneficiary. You don't include that, do you? You do. If you're the owner of the policy, you include the, not the cash value. So if you have a $3 million policy, it's 3 million, not the surrender value, which is, 400,000 or something. It's the full 3 million. Same as 401k. You say, well, 401k, isn't that, subject, I don't pay the income taxes on it. I only pay it when I draw it out. Isn't that somehow specially done for estate tax? No, we just add it all up, and then that's included. And then real estate, we add it all up, less the value of loans, but we add it all up along with everything else. So when you add these things up for Silicon Valley persons, the life insurance, 401k, and real estate, people sometimes get very, very high in the wealth calculation, and they may be subject to the estate tax. So for this, if you are a family that, let's say husband and wife, or an individual, and you are, right now over, if you're an individual over 5 million, if you're a couple and you're over 10 million, you need to really start thinking about the estate tax, gift tax, GST, generation skipping transfer tax right now. You have to look at it right now. And this is one thing where a lot of people, say, well, Mike, why are you scaring us? Why do I need to take a look at this right now? You just said this thing's not going to pass, and you said that Congress is all log jammed up with this thing, and it's probably not going to happen. I said, yeah, that's true, but that's actually the point. We know from the Build Back Better Act and what's going on in Congress that it is not going to be, what they pass is not going to be retroactive for the year 2021. So what does this mean as a planner? I can use the 2021 law, the law as it is now, Tax Cuts and Jobs Act, the 11 million, 11 million, 623 or 626, that amount, I can use it, and we can do gifting, we can do valuation discounting, we can do all of these fancy techniques, and I can have very high certainty that when we close the transaction and we complete the deal, the law is as it is 2021. I say, well, what if I just do it all in January of 2022? Say, well, you're taking some risk, because just like when the Build Back Better Act was proposed, if it's not passed, if it's passed this year, no problem. We already know it's going to be effective 2022. But what is likely to happen, even if it doesn't get passed this year, if it gets passed next year, January, February, March, April, May, sometime in there, it will probably have retroactivity to the first of the calendar year of the year that the bill was passed. So if you do the transaction in 2022 in January, and this passes in March, you may have a big problem, because you will have been using the law and the assumptions of year 2021 in a year 2022, which the law changed and was retroactive. And the Supreme Court has addressed this in a number of cases and said, as long as you are not creating a new tax, as long as the tax is not new, if you're just adjusting rates, exemptions, brackets, you can do that retroactively. Even though people will do transactions and then the carpet will be pulled out from under them, they said that's okay, because we know that that's the way that it works. They should have done it in the year before. They should have done it in the safe year. So my point for all persons who are higher net wealth individuals, if you are an individual, a single person, and you're over 5 million, come see me soon. If you are a couple and you're over 10 millions, see me soon, because we have a narrow window of safety where we say, okay, we can strategically gift out this 5 million and put it on an island for the beneficiaries, for the kids, lock that up. We can do that. And we have very, very low risk of that suddenly being recharacterized as a gift that was not subject to the exemption, because there was no exemption. In 2022, that's not going to be so safe. So we will have to be careful with that. There's also some changes, which we'll talk about in a moment, that are a little bit more nuanced, which we'll get into, of why we should look now. The last thing that we also want to take a look at and be mindful, and this is sometimes with the lawyers, sometimes with the accountants, and especially with other financial professionals, if you use financial planners, because financial planners are heavily involved in the two vehicles here, 401k and IRA changes for high net worth individuals. How you fund these and how these operate for high net worth individuals is going to be substantially different if the Build Back Better Act passes. And some things like the backdoor Roth conversion, you may have heard, is where you can sort of draw it out, pay the tax, and then backdoor it in, for a Roth, and you can do some of these things for long-term financial planning. That's going to be that's one of the key things the IRS is wanting to put the kibosh on and stop that. So that's something, again, you're talking to the financial planners and lawyers, accountants as well, but often financial planners, and asking, is this appropriate for me? Should I be aware of this? Because again, one's opportunity to do this safely gets exponentially riskier into 2022, because at that time we will be in an open year. 2021, little is going to occur, and it appears that nothing retroactively will occur. Let's just pivot a little bit more for the estate planning specifics. And actually, I just want to show you something because it's kind of funny. So let me pivot here one moment. I happen to have these on my desk, and this was a good lesson for people understanding about estate taxes. And when I was I still subscribe to the book service because I'm old. But when I first got into tax law, they said it's very important to understand the difference in the tax code and what we've been talking about. So one of the things, like we were talking about with income, capital gains, that's this book. This is book 1 of the Internal Revenue Code. So all of the rules and procedures for income tax are over here. But estate tax is over here, and estate and gift is done in an entirely different book. Two telephone book size books. I think each of these is about, let's see how long. Each of these is about 3,000 pages. So pretty hefty. What we're talking about and why I wanted to kind of show you physically the difference is our area, a lot of the estate planning, there are, in addition to changing the code, there are a lot of other subtle changes that can be done in that second book, which make estate planning for high net worth individuals and even ordinary individuals much more complicated, and why one would want to act now, earlier, sooner, rather than later. Obviously, of course, the rate change or the exemption amount change, that's massive. That's a massive sea change. But there are some subtleties that they are trying to put through. One of them that is quite significant is this rule that grantor trusts, these very, very attractive trusts that we have been using for high net worth estate tax planning. You may have heard it, sometimes called the IDGET, the Intentionally Defective Grantor Trust. These will work differently in the future, and these will not be excludable from the grantor's estate. So if you do the IDGET in the future, there may be an issue where this gets included in your estate. Again, an incentive to start planning this early and then create a sophisticated one that we call it can toggle, depending on what the law does. In addition to this, there's generally this concern is that distributions from these trusts would be deemed as gifts rather than just income. It used to be that if you created like an IDGT and your kids would receive the income, which is generally the design of these, that was just income and they would just pay the taxes on it. Of course, that was intentional and very smart, because if you are a high net worth mom and dad, kids are in college, they've passed the kiddie tax, they're outside of the kiddie tax, they're in college, or they have very low income. You place assets into the IDGT. You've, for estate and gift tax purposes, gotten this out of your estate, transferred it early, probably did, as we'll see, valuation reduction, valued it low, put it into the box, directed the income to the kids, and directed the income away from you to the kids at low rates. So you were able to give them the money and give it to them in a cheaper way. That, if the Build Back Better passes, may not work anymore, or may not work in the same way. If you create the trust now, you have some ability to finesse that to some extent. And then there's some rules about if you terminate the trust, or if you have sales or other things to the trust. There was a very common technique of selling assets to an IDGT. It used to be, under the current law, the transaction was not taxable for capital gains. So if I had a house, a rental property, and then I had this irrevocable trust, I could gift it, but then I reduce my estate tax exemption, or I could sell it to my trust. And if I sold it to my trust and I balanced it out correctly, I would have no gift tax, but in addition, I would have no capital gains tax, because under the grantor trust rules, we were the same person. I was selling to my own tax entity, and I paid no capital gains tax. The new change is that they want that to be taxable. So again, doing these transactions now, do them, October, November, December, we have 3 months, settle that up now, do it now, you're much safer. 2022, you always have that problem of any of these techniques that we do. There is a potential that the law, the Build Back Better Act, may pass, and what we did was substantially undone by that law and will have to be modified or totally undone. So much, much safer to do it now. Definitely seek guidance now while we can give firm answers. The last thing is also valuation discounting. For the estate gift tax, I always think about it like this: is you have cups, and my engineer clients love this. Is they say estate gift tax is just like a transaction, or just like a formula. It has to balance. Everything on this side of the equal sign and that side of the equal sign has to balance. It has to be a balanced equation. Equation equals. So the thing is, though, as a lawyer, most people who become lawyers don't really like math. And by not liking math, we usually say, I don't want it to equal, or at least I don't want it to equal in terms of feeling or in terms of the substantive effect. I want to get more out of the gross estate into the gift, and I don't want to use.
但係問題，爸爸你唔知佢出街嘅嘢係啦，你淨係 household，而家我同佢唔係 household 啊嘛。
Maybe we could mute. Yes, there we go. Yes, so we want to get more out of the estate than we pay in gift tax. And how is this usually done? It was usually done by valuation discounting. So with valuation discounting, we were generally able to take some assets, put them into a business vehicle like a limited partnership, put certain restrictions on the limited partnership, and then gift the limited partnership interest with subject to the restrictions at a much lower value. So if we put $1 million into the LP, locked up the LP appropriately, when we gifted the $1 million, the valuation of the LP interest, as determined by an appraiser, was often sometimes 20% less than what it actually was. So you would get $1 million out effectively, but you would only reduce estate tax, gift tax exemption 800,000. So you got a 20% reduction. If it was real estate, sometimes you would get up to a 40% reduction, and you would get $1 million out, but only effectively use 600,000 of your estate gift tax exemption. Works very, very well. But again, this might get closed. The kibosh may be put on this in 2022. So again, acting now is the way to go. Let's move away from taxes. So those are all of the sort of main broad brush things for taxes that we were taking a look at. Just want to focus on just a little bit briefly here about some estate planning considerations, because I'm still seeing, I've been in this area for 10 plus years. I still see a few common concerns or a few common problems that I would like to correct and help. Estate planning considerations. First thing, everybody on the call, ask yourself, do you have your estate plan? Do you have will, trust, power of attorney, advanced healthcare directive? To see people in the valley pass away intestate, with no planning, I have it all the time. And I'm always shocked because it is so frustrating for their family and so inefficient tax-wise. And people are so well-educated and so well-to-do in the Silicon Valley. I'm always puzzled by it. But it's something that simply happens. So first consideration is make sure, do you have a plan? Because if you have a plan, if you have the estate plan, will, trust, power of attorney, healthcare directive, all that, we have something to work with. We will not end up in the probate, sort of Kafka's trial situation of this sort of never-ending probate subject to very high fees. So we can get out of there. So having a plan, very important. The next problem I see very commonly is the plan up to date and is it current? So I have a lot of people that say, oh, yes, I have a plan. Say, oh, when was the plan? I don't know, 94, 96, I don't know. I had this, the person said, I don't know, the plan was, 94, 96. All I know is that Hong Kong was still British. Like, wow, that was a long time. That was before 1997. That's an old plan. And the problem with the plan date-wise is that the estate tax law, especially and this is critical for married couples, the estate tax law and how it dealt with married couples has changed many, many times. It changed in 2017, changed in 2013, changed in 2010, it changed in 2007 again, and it was very different prior to that. So the problem is that many old trusts for married couples, when one spouse passes away, causes the administration of the trust to be very strange to the law now, which is actually quite good. And the old trust often will lock the husband's share, and that gets locked up, and then he'll pass, that's all locked. Wife wants to sell the house, the trust allows her to sell the house, but then half of it has to be held in trust that she can't use and held in this strange locked box that she's only allowed to get income from, she thought, well, I'm just going to use that to buy a new house, but she can't. a lot of old trusts have these traps. What are those? The classic AB hard lock trusts. AB trusts, and this is the real irony. If you, because it's counterintuitive, the higher quality your estate plan was, the higher end lawyer, the more sophisticated lawyer you had in the past, will cause the current trust to be the most outdated and the most to work with. Why? Because high quality lawyering, sophisticated lawyering under that time was very attuned to the estate tax and really tried to create a very good trust at the time, very high quality. If anything happened, would have served you very well, but it was very rigid and it would lock things up. And it was excellent at the time. You did the right thing, the lawyer did the right thing, but that really high quality estate plan is now really in need of update, because what it tries to do and do very strongly is contrary to the law now. So I often have a lot of clients say, oh, I went to a top lawyer 10 years ago or 15 years ago, premier, really great. Why would I change it now? And it's ironic that actually sometimes the crummy, internet trusts that really did nothing do not cause such a problem as the ones that were really well done, because the ones that are kind of crummy, they never solved the problem anyway. So it never created any structure that did anything. So, it didn't do anything then, it doesn't do anything now. The really good ones did something because they wanted to solve a problem, but what they want you to do is now not a match with the law, and it kind of causes a problem. Any trust, I would say older than 2015, you better really look at that. Anything over 2013, absolutely, because 2013, the entire system changed. So really look at the date. The other thing one has to take a look at is people say, okay, mine's from 2019, really good. Date-wise, I'm fine. What about family structure? What about family status? How, were the kids, did you have a switch over from the kids as minors under 18 to over 18? Maybe you need a refresh. Should the kids play a greater role in the trust? Did anybody move away out of state? That's the thing with COVID. Did people move out of the area? If your family moved out of the area, then maybe that's not a good trustee. Maybe that's not a good healthcare agent. Maybe that's not a good choice there. So for the currency of the plan, there's date, but there's also the arrangement of the family. The second thing is, of course, or the third thing is, going beyond that is, of course, optimization for taxes. We talked about the estate tax to death, lots and lots of that. The other thing is, what about local? Is your estate plan older than, this, maybe late last year, late, 2020? Why? Is it optimized, or did you think about Proposition 19 California? Have you thought about the situation where all of the rentals will be reassessed for property tax purposes, and the family home, if there's more than $1 million of increase and the child doesn't live there, that it will also be reassessed? Has this analysis been done? If not, there may be, again, a little time bomb in this trust, in that all of a sudden one will realize, like, wait a minute, I said, the family house was going to go to Janice because she works out of state. She's a floating doctor and saves people around the country. And she's a wonderful person, and this will supplement her income. And then my son, he's local. He has a good job. He'll just buy his own house. And I'll give him the financial assets. That may have made sense pre-Proposition 19, but it is totally flipped post-Proposition 19. If he's in the area and he can live in the house, he should get the house, and she should get the financial assets. Because if she can't live in the house and she can't claim the homeowner's exemption on the property tax, it's going to get reassessed. So I see this a lot is optimization, of course, estate tax, but thinking about real estate, and did we think through where it's going to go? Do we have some Prop 19 provisions in there? Because that's going to be important, so that we don't direct things the wrong way. Also, be very, very, very careful, friends on the call, of parent to child transfers now. I still see people very frequently, they hear news about Prop 19, and then for some reason they are not clear on how it works, and that it actually did pass and was effective for parent to child transfers February 16th. And people will try to do transfers now. And you can do some transfers, but you have to be very, very careful. And it is not the old law. It is not the unlimited exempt transfer. Transfers now can cause reassessments. So be very cautious about that. Fourth thing that I'm seeing, which is also very significant in the Valley and for estate tax purposes and general planning purposes overall, is your plan optimized if you are the beneficiary from others? So I have a lot of my clients that we talk about their planning, and we plan for mom and dad, and I say, well, wait a minute, that's all great. Are either of you going to inherit? And more often than not, I have somebody who husband or wife, wife says, oh, my mom and dad live in Hillsborough. They own the house. Yeah, I'll probably, I'm the only daughter. I'll probably get the Hillsborough house. Say, how much is that worth? $4 million. Whoa, we may have an issue. You husband and wife don't. But if you have this problem, and it's a nice problem to have, but it is a problem, all of a sudden we get a plus 4 million, plus all of that from your parents. And then what you already have, now you're over the estate tax exemption. Maybe we should kindly talk to your parents, and maybe we should do something where their plan bypasses you, daughter, and goes to the grandkids. Or maybe we do something where that's placed in trust, or we in an irrevocable trust in another way, or we do something, or we're funding 529 plans, or we're doing something sophisticated. But I've had this happen recently where people were, their plan, husband and wife, or the individual client was well done. It was optimized, but then it didn't consider, well, wait, my parents, I may, and this is doubled for husbands and wives, or couples, where you get from both sides. Well, if we inherit on both sides, then we may be way over. So that's the estate planners, we call this the waterfall problem of the generation, one, grandparents' generation flows to generation two flows to generation three flows to generation four, and this accumulates, but because of the estate tax, it gets scooped out. So you have to do some sophisticated planning to prevent the water from basically the water's overflowing in cup one. My son's small, 3 years old, and has this thing that's like a tea. I should have brought it. It's a toy for the beach. It has cups, and you pour water in, and this cup overflows and pours into the next one. That one overflows and pours into the next one. And I said, that little toy is the perfect metaphor for estate tax planning, is that this gets overfilled, and then it overfills the next one, and it overfills the next one, and the spill, every time it spills, that's the estate tax. That's money getting pulled out. That's money that the family is losing cumulatively. And there's a Chinese expression that family wealth is lost in 3 generations. The estate tax certainly makes it very tangible and a good try. So optimizing for the total family operation is very important, because that's another one where I see suddenly people saying, well, I got to slide in 4 million that I never expected. Or I expected, but I didn't, I always thought it was my parents. I never really thought it was mine. Well, it isn't yours. But in terms of the constellation of how it's taxed and where it flows, we have to think about it that way. Other thing, which, segues right, from 4, is, does your extended family have planning? I see this, I usually see this where people end up having to deal with some other family members' plan, and they say, oh gosh, uncle or aunt, something happened to them. I think I need to start, they didn't have kids, they weren't married, or their spouse passed away. They didn't have any will, trust, or anything. Oh, I have to probate this. I have to be the administrator and go through court and do all of this. I have to handle all these things. That's really unpleasant. When there's no plan. If there's a plan, it works very well. So planning for the extended family. The other thing, this one I had happen just earlier this year. planning to some extent for adult children. Again, adult children, they're over 18, they're autonomous adults, but something to consider, especially things like advanced healthcare directives when the kids go off to college. I had a client situation that did this kind of through us. Client, the son went off to college, went off to Cornell. He's way out in Ithaca, New York, apparently gets very, very sick in Ithaca, New York. He's admitted to the hospital. He's very, very sick. Basically, mom and dad don't hear from him at all. And then luckily, the roommate, who was just a decent young man, realized that he was very ill and realized that there was probably no communication, called them and said, hey, Johnny's really like unwell and he can't communicate. Do you know about this? And then mom and dad are like, thank God you called. I didn't know about this. I didn't know anything about this. So they, of course, call the Cornell Hospital. Cornell says, Cornell Hospital. They say, oh yeah, we're the parents of Johnny. We want to know how he is. And they say, I don't see any, healthcare power of attorney. I don't see any, healthcare advocate listed on here. I can neither confirm nor deny that Johnny exists here. Goodbye. And phone slam. Terrible situation. Of course, they end up flying out to Buffalo, New York, driving to Ithaca, whole big thing. But what was startling, eventually, of course, Johnny is fine. He just, became very, very ill and was, sedated and had to have surgery. But the point of this is that because we often don't think about this way, but it is the way that it is. Once one passes 18 in California and the law of the United States, they are an autonomous, separate individual. And your ability as a parent to tend to their healthcare, to tend to a lot of these things, drops away. Even though you say, well, I'm paying for the darn Cornell education. I'm paying, for the Cornell insurance. Well, shouldn't I have some say? No, not unless the child, the individual who's not a child, who's now an adult, consents. And vast majority of my clients, of course, the children say, of course I want this. I want my parents involved. If something terrible happens when I'm at Duke, I want them to be the first call. I want them right there. Of course, that's what I want. Well, we better document that because what the law sees is they see you as an 18-year-old autonomous young man. And they see you, they don't know whether you are a loving, harmonious family or you went to Duke because that was the farthest you could get away. And that was as far as you could get away from them. They don't know the difference. So how do they know the difference? Advanced healthcare directive, maybe if it's appropriate power of attorney. This is something that, again, we generally, we're not so active in planning until we had the case of the family with Cornell, and they said, this is a nightmare. Our son is unwell and we can't get information, and they say we can't be involved. It's a huge hassle. And then we thought, you know what? This is why, what we do. Solving these problems. And that was something that was kind of a wake-up call of thinking of, we always think of the planning for, when people get into their more, golden years, but actually we have to think about a more global, holistic planning for the whole family. So that's that. Last thing, I'll just say a little bit, just briefly about Proposition 19 before we go to some questions here. Just a little bit where the focus is. There's two parts of Prop 19. One is the over 55 transfers. That's sort of a separate thing we talk about separately. The other thing is the major change of Prop 58 was repealed. Prop 58 is gone. Well, Prop 193, but that's for the grandparents, grandchildren. We just have Proposition 19. Key thing is the transfer of rentals. Parent-child, there's no exclusion. That will be reassessed. Primary residence can transfer that if parent to child, has to be the family home. Transferee has to live there. It's also limited to $1 million of value, have to file the exemption within 1 year of that transfer. The old rule was 3 years or before transfer to a third party. So the Proposition 19 is worse. It's worse. It's a tax increase. But it's something that is simply the law. So we just have to monitor that. So this is my contact information. I think we have a number of questions, and some of the questions which I'll have to say, and I have to put out this disclaimer, sort of sort of at the beginning, but here is that this is for academic purposes. I say academic purposes. I suppose I could say this is for entertainment purposes. This is for academic purposes. This is not specific legal advice. Please contact me directly if you want really specific legal advice. Even when I am answering the questions here, this is for academic study purposes to follow up. Please do not take an answer and then go conduct a transaction, because what we're basically doing is sort of the radio call-in show. I have the basics of the question, but again, the devil is in the details. I would likely, before I say do this transaction, need to know more details. But this is helpful and in fact critical, and I'm really thankful for Monica Young and her firm to invite us, because my hope is with this is we're pointing you in the right direction. And critically, what we're trying to do, and Monica is really doing a great job with this, we want you to be an informed consumer of legal services. I want you to know what it is and know what you're buying, because if you know what it is and know what you're doing, you can do it better. Otherwise, you just walk in and say, I think I need an estate plan, and you just get whatever. And once it's the same way like with a car, you don't just go to the lot and just say, I need something with 4 wheels, or maybe 3 or 2 in the right situation. No, you know what you want. You say, okay, I want this particular car. I know this one's particularly reliable. And then you know about it. And then of course, if you know about it, you get the right thing. Otherwise, you may get the wrong thing. So let's have at it.
Yeah, thank you very much, Michael. This is very, very informative. And I think definitely all the attendees, including myself, learn a lot. So I have a couple of questions posted in the chat box. The first one is from Becky.
Yes.
She asked, should you start estate planning once the total asset, including real estate, exceeding 5 million before end of this year? And or maybe for 2 people, like husband and wife, that's 2 times, so that's 5 million combined. So what do you think?
Okay, so this is a good question. I'm really glad Becky asked this. When should you start estate planning? We have to divide out the estate planning with regard to sort of like estate tax and just general good estate planning. General good estate planning, this is just having your will, trust, power of attorney, healthcare directive. You should start this very, very early, regardless of the wealth. The critical times where you should start doing estate planning, or what usually triggers the need to do will, trust, power of attorney, healthcare directive, the estate plan, is really, first thing is real property. Do you have a house? Why? Because that causes probate. If you don't have a trust, it has to go through probate if something happens to you. The probate process is very slow and very expensive. So even if you have a house that's $300,000, you're out in, Inyo County, you will be well served with a trust. That will save you money. That will save you trouble. Even though you say, I am nowhere near the estate tax exemption. For that $300,000 house, we charge, 4%, 2%, 4%, 3%, 2%. So that is, 4 plus 3 plus 2, we're at, $9,000 to probate a $300,000 house, because that's how we do the calculation. So that's quite a bit of money, $9,000. When you can do the trust, for that is $2,000, maybe less. Plus you get all the benefits of the trust. So really thinking about estate planning is, do you have real estate? And then critically, even if there's no real estate, do you have children? Do you have children? Because that causes guardianship, and it causes questions of who the guardian is. So doing estate planning there. The other thing for thinking about for estate planning, which is very important, is for individuals who are not married. So a lot of people think, oh, I'm not married, I don't need to do this. Actually, you're more complicated. Unmarried individuals, married individuals, I assume it goes to the spouse, and then I assume it maybe drops down to the kids, and then it goes, this way, that way. Individuals are much more varied in what you want. So again, if you are a single individual and varied in what you want, that is very helpful to guide what you want to your preferences, and especially for things like I mentioned for the young man in Ithaca, New York. If you're a single individual, things like the healthcare directive. Again, who's going to come to the hospital for you? For husband and wife, we assume it's the wife, it's the husband. And you already have a legal relationship that's recognized in law that we're going to talk to the husband and we're going to talk to the wife. If you're a single individual, more complicated. So I would say, don't wait for values, Becky. Think about your situation. Do you have real estate? Do you have children? Are you a single individual? I say, really, if you're, have relative assets, take a look, start doing it, because it's not expensive, it's not difficult, and once you have it, it really lasts a good long time.
Yeah, definitely noted. So there's a question from Alex, and Alex Yep would like to know, can property transfer into irrevocable trust be put on sale?
Yes. So this is interesting. So when you have an irrevocable trust, think of the irrevocable trust as just a separate box. So I have my box, which is my revocable trust. Usually on my estate, I have another box. I take the property out of this box, I put it in the irrevocable trust. There, we will have to settle somehow the gift issue, because when you put it over there, the equation was unbalanced. So when you put it over there, either it's through a sale or it's through a gift, we got it in there. Once it is in the irrevocable trust, I would say all irrevocable trusts that I draft, the trust is allowed to sell it. And it's always allowed to sell in the irrevocable trust. Some things like a charitable remainder trust, you have to sell it because the charitable remainder trust doesn't work otherwise. You must sell. But once you have it in the irrevocable trust, you can completely sell it. Depending on how the trust is designed, and this is again why you need a sophisticated attorney in this. If the trust is designed as a grantor trust, the capital gains will flow back to you. You will owe the capital gains. If the trust is well designed, it will allow the trust to reimburse you, to pay basically whatever the transaction cost you in taxes, it pays you back. The remaining money stays in the irrevocable trust. So this is critical. So generally for most irrevocable trusts, when I put it in there, the beneficiary is not me and not my spouse. It's usually my kids. So for that situation, that money is there. It can be used by them, but I cannot dip into it. And the same way, if I reinvest it inside the trust, so I can take the house, I could sell it, get cash, allocate that amongst financial portfolios, grow that. But again, I can't dip into it. So the irrevocable trust, you can sell, you can do all of those things, but you just have to remember the sanctity of the separate trusts. They're separate. You can't commingle, you can't dip into them. And you do have to remember the equation. You have to balance. So working with lawyer will help you make sure that you've balanced to get it in, and you don't cause some, they call it a breach of trust, classically, if you start dipping into that. And that can be very, very problematic for tax purposes because the irrevocable trust is a separate tax person.
Yeah, got it. So I have a question from Helen Lee, and she asks, for selling a home to trust, that you don't have to pay any gift tax, no capital gain tax. However, eventually they do need to sell the home. Do they still need to pay the tax capital gain at that time? So what is the benefit of having it transfer into a trust?
Yes, it's a good question, Helen, and I think it's a foundational question. For the only reason you sell property to a trust is for estate gift tax purposes. So the only reason you would bother to do this is because your estate is so large, you are over the estate tax exemptions, or you're getting up to the estate tax exemptions. And just like we were talking about with Alex, is we're saying, I need to balance this equation. And we do this sale from me to my trust. So the design of this and the objective of this, of selling to the trust, the issue is with regard to the estate gift tax. For income taxes, it is really generally not particularly helpful, because for most of these trusts will be a grantor trust. The income tax, capital gain tax result is the same. It does not cause any change. So for that question, Helen, it's really if the person was a high net worth individual, that's where that starts to operate.
Yeah, that's very good to know. So there's a question from Jessica, and she asks if a parent can gift 15,000 from his or her Roth IRA account to the adult child's Roth IRA account.
This is complicated. I generally have, Jessica, follow up. One of the problems with this is that when you are gifting, Roth IRAs generally need to be funded with earned income. And that is one of the restrictions where I would say that it's this gifting procedure. There are certain complex ways where there are like we were mentioning, like this backdoor, the conversions and things like that. But generally, things like Roth IRAs, you have to have earned income and then you fund it from the earned income. So it's very, very common that if one has a business, as my children are too young, but it's very common if you have a small business, all of a sudden, once my kids hit, past the kiddie tax, 18 or 19 or 20, they hit that, all of a sudden he becomes junior clerk and becomes he's cleaning up the office and doing stuff. And the reason is because I want to give him some salary because I want to start funding that Roth IRA real quick. And that tends to be actually the more classic way, is because I cannot generally just, as a gift, there are some concerns about that. So for the specifics for Jessica, I'd say follow up with me, because there are a little bit of problems with that because of the rules where it has to be funded by earned income.
Yes. Yeah. Okay. So none about it. So a follow-up question from Becky. She asked if regarding a living trust, if a spouse passes, does it switch to a AB trust? And how does an AB trust work in relation with a living trust?
Well, Becky, I'm so glad you're here. You asked these questions that I really want to answer. So I really thank you for asking these questions, because I really actually wanted to talk about this. So and this was what I mentioned before on our considerations, this, date and current of the trust. The AB trust. So does the trust switch to an AB trust? The first thing is, how was the trust designed? Some lawyers design them as AB trusts. Quality lawyers, back in the past, you generally always did, and they were done as they called them like strict or hard AB trusts, where when one spouse died, so the trust as it was created was designed as an AB trust. It didn't mean anything until the first spouse passed away. And then when the first spouse passes away, generally that A share locks. And that A share locks, and the surviving spouse has limited access to it. The reason that was that way was because of the estate tax rule before 2013. And basically what it was, I'll say frankly, it was stupid, the old rule. And the old rule was dumb, and the solution was also dumb. And basically what the rule was is, under the old rule was that each person, husband and wife, had his or her exemption amount. And under the old rule, it was use it or lose it. So if I went, so I'm a husband and wife, if I went, at my time when I pass, my spouse needs to, under the old rule, needed to file and claim the estate tax exemption and use the $5 million. But she couldn't just inherit it, because if she took it, she's not using my exemption. She's using the marital exclusion. It's a different concept. So there was this and I say like dumb and stupid, and I know those are harsh words, but is that we lawyers basically created this fiction that we said, well, because she needs to use the exemption, let's just lock the husband's share in this A trust, file the return, use the the 5 million, and then anything over the 5 million will bypass. We'll use the bypass trust for the marital exclusion, and we'll move it over. This is if he has more than 5 million. And it created all of this trouble of like the A trust locking, the spouse can't get to it, it's difficult to administer. Also, the IRS started to realize it's also very difficult to tax report, and they were getting these like really complicated returns. And finally, in 2013, the IRS and the sophisticated tax writers said, well, this is really dumb. What if we just do this? What if we say, and this is called what we have now, this current law, the deceased spouse unified exemption, the DESU. And we say, what if we just do this? Husband goes and his property can go to his wife. And how about his exemption can go to his wife? She just gets both. And she'll take the money and all the property, and his 5 million will just go over there. And now she'll go from, let's say, if it was 5 million, she'll have her 5, and now she'll have his 5, she'll have 10. And then when she goes, we just draw a line, we add it up, we subtract the 10, and there we go. Why don't we just do that? And we don't have to do all of this locking and AB stuff. And everybody in planning said, thank you. Thank you. That's what we've been saying for years. This is the old way didn't make any sense. And then the problem was the fix was, what was annoying for tax lawyers is because we always want economic substance. We want reality. The taxes should follow where the money, it's, follow the money, show me the money, where's the money going? Who's benefiting? The tax should follow that. The AB trust under the old rule and the IRS, allowed it and blessed it, was basically a fiction. That was not the way the money was flowing. It was not the way the transaction was working. But we had to create all of this fiction to satisfy the tax law. And finally, they fixed the law. We don't have to do this. So to answer Becky's question, how do we do it now? What do you want now? Basically, what you want is a recent, trust, anything, after really 2017 is best. A trust that has the AB provisions, because there are reasons why you still need it, but that's basically, we call it the AB trust we call it sort of the light lock or the springing lock. And basically what that means is that don't lock it up unless we need to. We have AB set up, but unless there's some reason that when we look at it under the tax law, we have to lock that A share, let's just let wife use it or let husband use it. And if there's some reason that we have to lock it, then we'll lock it. But the default is it basically, just goes over. The estate tax exemption just goes over and we're good. So that's the modern way. So like for Becky is, if you have the old AB trust, you really want to modernize that because it will be a pain in the butt if you have to deal with it in the future. The other thing, and I sorry to go so long on this, but it's really critical, the second part, the estate tax return. Please, friends, if someone passes away and they have a few $1 million, contact contact us, contact the lawyer. Really consider filing the estate tax return. Why? People say, why do I have to file that stupid return? Say, hey, do you want a free $11 million? Yeah, that's why you file the estate tax return. Well, you don't get the $11 million, but you get the exemption ported over. Because remember, with this deceased spouse unified exemption, the exemption exists, but the surviving spouse has to ask for it. The surviving spouse, husband or wife, has to say, oh, my wife passed. I want her exemption. I want his exemption. Even though the person only had $1 million, they have $1 million of their assets, but they have $11 million of exemption. Take it. Take the exemption, bring it over, because you can do now, if the person passes away. I have an exact case like this. One spouse passed away last year. They're entitled to the $11 million exemption. That now, when we filed the return and brought it over, spouse has it permanently. She's got the 11 million. And let's say the exemption goes down to 5 or goes down to whatever, she's got 11 sitting right there. And so she actually, by capturing that, has captured a tax asset, we call them tax assets, that she's got an exemption that when she goes, it's going to benefit her children substantially because she will, let's say it is 5 million, she'll have 15 instead of only 5, because that would have just been hers. So definitely think about filing these returns. A lot of people say, there was not enough money there, I didn't file the return. File the return. It's due 9 months after the person passes. There is a revenue procedure that if you forget, you can do it up to 2 years. If it's after 2 years, you have to request a private letter ruling, and that's really complicated. So always consider filing the return, especially with those AB trusts, because you will be really well served. The return is not extremely expensive to file. And you having that credit there, why not, have the credit there.
Mm-hmm. Yes. Okay, so next question is from Tim, and he's asking, would it be 5 million or actually 6.03 million for estate tax exemption if the new law passes? Do you know yet, or yes. what is the guesstimate?
Yes. And actually, this one I can answer for Tim, because this is a confusion. Even when I glanced at the news and the law, I had the same confusion. So the exemption amount is adjusted for inflation. So the law, if you read the text of the law, it will say 5 million adjusted for inflation. So if this passes, it says 5 million adjusted for inflation. The result, because you adjust for inflation, is like 6.3 million. So to answer Tim's question, if it passes, it will be about 6 million, and change. The law text will say 5 million adjusted for inflation, and the IRS will produce the exact number in there. They call it the regulation. So the code will say 5, but what you will actually be able to use is about 6. The same way, like the Tax Cuts and Jobs Act says 10 million, but the amount adjusted for inflation is about 11,600,000. So the answer for Tim, it's the higher figure. So it's a little bit better than 5. You get an extra million. So you're good there.
I see. Great. Lauren's question is, what are the pros and cons of special needs trusts, especially the beneficiaries receiving SDI?
Oh, fantastic.
I think disability income from government.
Great.
And is it better not to set it up? It's too much issue. Any other options?
Yes. Well, I promise you all these are live questions and they're not planted questions. You're all asking the exact questions that I really want to give you answers to.
They're very specific.
Yes. Well, but these are great. I'm really happy to get these questions. These are really important things that I want to answer. So for Lawrence here, 2 things about the special needs trust. Special needs trust, 2 tracks. There are 2 tracks. First track, highly recommended, or something to consider. If you have a special needs individual in your family, particularly a child, one can create inside, and you really should create inside your general revocable living trust. If you're going to give the special needs individual a share, you should create in your trust the share for them with special needs or supplemental needs provisions, because you wouldn't want a situation where if I go, and this is one of the most common situations for special needs individuals or elderly people getting kicked off their benefit system. I mean, you're entitled to the benefit system. So, it's government entitlement unless you have too much money. And you wouldn't want a tragedy to kick the person off. You wouldn't want to compound the tragedy of the person losing a parent and then being kicked off the entitlement system and being told they can't go to the regional center, they can't go to the school that they want to go to because you're not qualified anymore. So the first thing track is, we call it the revocable track. So make sure your general revocable living trust has the provision for the special needs person that is a special needs trust that we call it a third-party funded trust. So it's not from the assets of the special needs person. And what is very, very good for this, and what I really counsel families with this situation, is think about this special needs trust, of course, taking care of this person, taking care of the person long-term. It needs to have the special needs provisions, because we don't want the inheritance to disqualify them for benefits. And then we also want to think through the trusteeship and whether or not the trustee can hire a care manager or administrator. And this is one of the key things that I've had, counseling special needs families, is that some jobs are better suited to professionals and some are better suited to family. And especially in a family with some special needs siblings, you want to encourage and enhance the love and connection between the children, but you have to separate that there is some burden of administering this trust and taking care of the special needs person. And what I often see, or sometimes in ones that are not well crafted, is that one of the brothers or sisters says, I have to take care of my other brother or sister. I have the entire burden. I have to do all of this. And it's puts them in this awkward position, is that they love the other sibling, something extremely deeply. But then they say, but I also have to live my life. And how do I balance these things? And what we always try to craft is a situation where the loving sibling, or whoever you design, they get to keep that role. But for things like the administration, they're allowed to hire a third-party care manager to say, well, care manager, I need you to be the one to manage the group house and then report back to me, weekly or monthly. I need you to be the one to work with the regional center, work with their hospital, work with their thing, and you report to me. But I don't necessarily want to be, I want this packaged in a report that I approve. I kind of don't want to be driving all over town because I have to work. And it varies client by client, but I've often seen that be very successful in saying I get to be loving brother. But then the administrative paperwork, I do just hire somebody at $30 an hour and they just run around San Jose and they solve it for me. And then they report back, I approve it, I sign, and it's good. So that's one of the key things is, for special needs trust, build it into your trust to make sure you don't have an inheritance problem. I sometimes see people do this, where sometimes they will say, well, I will just exclude the person, I will exclude the disabled person or the person with special needs, and I'll just give it all to the other son or all to the other brother. And like I said, that sometimes causes this burden on that person of saying, well, I got all of mom and dad's money, so now I have to take care of my sister. I love to do so, but like it's very hard. And then their money is all commingled with mine. Tax-wise, that can sometimes be a very big mistake, by the way, with the state taxes, because you instead of dividing it, you consolidated it. So definitely something to think about. Just one other pivot for Lawrence is there's another version, or two other versions. One is where I can start creating an irrevocable trust now, and I can start funding this irrevocable trust for the special needs person now. And that can be an effective way to sometimes use the annual exclusion. So like the $15,000 per year, your husband and wife is $30,000. If I'm a higher net worth person and I need to draw down my estate, maybe I need to create the special needs trust now and start kicking in $30,000 every year to start funding it. Because if I'm up in, I might be subject to a state tax, I need to get that money out. And I have, many, many years to get that money out. The third one, so, that's that technique. The third one is a special needs trust that's a self-settled special needs trust. This is very complicated. This is generally more designed or tends to happen in this situation, and is somewhat quite complicated, is where my need or disability sometimes occurred from an accident, and where I was subject to an accident or some sort of issue where I, the special needs individual, am entitled to, let's say, a lawsuit recovery. I was hit by an automobile and I'm going to get $10 million. That is my money. It's not my parents' money. It's mine. that is placed into a particularized self-settled special needs trust. That is very complicated. So the bottom line I'd say for Lawrence is think about of the three, which situation do you have? Is it just parents preparing for the future? Is it high net worth parents that we need to prepare for present and future? That's the kind of middle option. Or is it the third one, the person got some sort of recovery? The challenge with special needs trusts, options 2 and 3, is that those do tax reporting now, and they're as you mentioned, there is some trouble for those. Option 1, no trouble, because it's built into the revocable living trust. It's just making sure that you don't have a problem in the future. So the number 1, I highly, highly recommend. That would be the way to go.
Good. Well, we are running a little bit tight on time. I have 2 more questions so that I think we cannot accept more. But for the rest of the question, we definitely encourage you to reach out to Michael's company during the weekdays, and they have very good, receptionists will be able to connect them to Michael. So, I already have another one. Okay, so it's going to be Kelly's question is going to be the last, but before I go to Tim and Kelly's question, I do have like an attendee, Jay, who asked about a Proposition 19 question earlier.
Oh, sure.
And Jay asked, she said she acquired property in East Palo Alto like back, say before April of 2021. So it's like a couple of years ago. She lived there for 2 years, rented it for 1 year, and she has the cost is lower, $900K. And then she moved like back in say only maybe 2 years ago, and she now lives in a new home, and that costs 1.3 million. But she was thinking that if she's going to buy another property as her primary, that is going to cost 2 million. Can she still use the 900K basis back when, before the actual Proposition 19 takes place?
Oh, yes. Is this my thought is that this is for an over 55 transfer, is probably for that. My recommendation for this question, because it is a timing question, would be kindly contact me directly. What we're dealing with here is what I think is the Prop 19 portion, the over 55 transfer, not the parent to child, because this sounds like taking a property tax basis from a prior property that was a primary, then went to a rental, and then moving it forward. There is some technique there, and this would result to a kind of like a yes or no answer, and I would not want to give that answer without nailing it down, because this could be could be massively wrong. So I'd want to gather up all the facts. There was just a quick question I think Tim sent just about this step up in basis. That's a quick answer. Was not in the big Build Back Better proposal. They didn't put it in. So like all of that hubbub about they're going to take away the step up in basis, not in the Build Back Better proposal. So that seems to be off the table. So with that, it doesn't look like they're going to change Section 1014. Looks like we still have step up in basis. Real estate holders, looks good so far. So, it makes sense because that was just such a nuclear weapon of an option that everybody was like, that's just so extreme, been in the code since 1954, so that looks okay.
So capital gain probably, say for the step up basis law, it looks like will be saved for now.
Looks like it's staying the same. Looks like that seems like a hive of bees that they do not want to poke. I mean, even they realize if they poke this thing, the bees are just going to explode out of this thing, and they just, so the law of step up in basis looks like it's going to stay the same.
Okay, got it. Yeah. So I think probably, Bill have a question about MetLife, and you can actually reach out to Michael directly, whether, you are involved in the MetLife Group legal service. Bill, you can reach out to Michael directly later. And just please help us with Kelly's question. It's going to be the last one. So I think you probably can read it to Michael. About how to avoid building become rundown.
Really what this is, for your question, Kelly, is you'd want to build this into your revocable living trust. And the critical thing would be is to create language that you'd say, I want this home or this real estate property to be retained in trust as long as possible. So you'd want to instruct the trustee, don't just sell everything, keep the property here. And what you will also want is a quality trustee. So one of the things to think about with both of these things is, one is their language, where trust the trust and trustee is instructed to keep the property, and that the trustee is sophisticated enough to operate it as a rental or operate the series of properties as rentals, and ensure that the wealth repository keeps operating. The objective of it wanting it that only the income is given to the children and the grandchildren, that is entirely doable as well, because once one passes away, your revocable trust becomes irrevocable. And for the income taxing of trusts, providing it stays the way it is now, income of a trust, of an irrevocable trust, you always want to pass to the beneficiaries, because if you retain it in the trust, it's taxed at a terrible rate. So you always want to push that out. The only thing that you would have to consider, or which if this is for Kelly, a very strong objective of yours, is you do need to think a little bit about this thing called the GST tax, because you will have a generation, you will have skipping potentially. So what you might have to design in this trust is just to create the trust in a sense a little bit more like a dynasty style trust, where the beneficiaries are the family line perpetually. Assets are not supposed to be liquidated. Income is to be allocated by discretion. You can design that. So what you are seeking, Kelly, is very doable. The way you do it is a good trust design, and then thinking through good trustees. And by good trustees, you may want to consider a situation where there's more of like a professional trustee, because if you just leave it to the children, sometimes maybe they won't, it's maintaining the real estate's not their forte. So you could have a problem there.
Yes. So you answered all our questions, Michael. Thank you so much for your valuable time, especially on a Saturday morning. And thank you, everybody, for attending this event. Yeah, so if you have any questions, please reach out to Michael directly, and we're going to email the presentation PDF as well as the recording link probably by early next week. Thanks again, and please have a wonderful weekend.
Yes. All take care and be well. And I look forward to hearing from you all in the future.
Thank you very much.
I really appreciate that. Yeah, thank you. Bye-bye.